Hey there, happy to have you here for another credit building video. This time, we're talking credit utilization. We'll go over a few things you need to know about utilization and some good practices for keeping it at a solid level. So the first thing you should know, your credit utilization ratio accounts for 30% of your credit score. This makes your credit utilization the second largest factor in your credit score. Now that you know how impactful it is, you should really pay more attention to your utilization. To keep it in check, you need to keep your credit utilization at or below 30%. This is the industry standard for a good credit utilization ratio. If you don't know what your credit utilization ratio is, it's pretty easy to find out. Simply divide your total balances by your total credit limit. If you include all balances and limits, you should find an accurate percentage of how much credit you are using. Keeping your limit below 30% is typically easier said than done. The most common advice to lower your credit utilization ratio is to pay down your balances. And while that is simple and works great, not everyone can pay down their balances just on a whim. Here are a few ways to lower your credit utilization ratio without paying your credit card balances. A very good option for decreasing your credit utilization ratio is to request a credit limit increase. If you call your credit card company, politely ask about increasing your credit limit, and highlight your on-time payment history, there is a chance that they will increase your credit limit. If you get a credit limit increase, your ratio will go down. Another way to increase your credit limit is to open a new credit card. For your credit utilization ratio, this works in the same way that increasing your limit on one card does. By adding a new card to your file, you are instantly increasing your credit limit. Due to this, your credit utilization ratio should see a considerable improvement. That's assuming your balances stay the same. Just make sure you make your payments on time and keep your balances in check. If you are not in the position to pay down your credit balances, increasing your credit limit is a valid way to lower your credit utilization ratio. This might not make immediate sense, but closing your old cards can actually hurt your credit utilization ratio and your credit score. You may be able to manage your finances easier, but closing a credit account will lower your total available credit. When your available credit is lowered, your credit utilization ratio is increased. This is the opposite of what you want. One more reason not to close old credit cards is for your credit score. If you close an old account, your payment history and average account age will be affected, which will likely decrease your overall credit score. Keep those old accounts open. If you're not able to increase your credit card limit and you are not able to, or just don't want to, get a new card, you still have an option. Just spend less money. Again, easier said than done, but if your credit limit has to stay the same, the only way for you to lower your credit utilization ratio is to decrease your balances. Now, this may not be possible for everyone, but if you can, spending less will enable you to bring the balance lower than otherwise, which would improve your credit utilization ratio. When your ratio is lower, your credit score increases. When your credit score increases, you're going to be able to increase your credit limit again and start spending big again. It is a process, but spending less money now can open up opportunities to spend more in the future, all while increasing your credit score. Paying down your balances is a good, straightforward way to lower your credit utilization ratio, but that does not mean it's the only way. In the end, you just got to do what works best for you when trying to improve your credit score. If you have any questions on how to do that, reach out to us or leave a comment down below. As always, good luck.